I would like to talk you through a number of bullet points, a number of data sets that we collect and which I think are useful. Before I start this, however, let me introduce TGN with a few words. And in the interest of immodesty, I begin with a citation here by Pascal Saint-Amans, the head of tax at the OECD, which I think is fair to underline how TGN has been supporting and helping to shape the international tax agenda and reform agenda in the last 10, 15 years. And about us a little bit, so I'm a director of governance and financial secrecy at the Tax Justice Network. We are a bit of a strange beast, like somehow sitting in between the spectrum of a think tank and a network of experts. We have 21 staff dispersed around the globe, and these are mainly economists, lawyers, journalists, and political scientists who work together. And if you want to choose one of the core themes that we are about, it's about illicit financial flows and how to counter illicit financial flows. And we do this with a perspective of creating and pursuing long-term systemic changes and shifts in narratives that can support policy changes. We don't see ourselves so much as firefighters, like being involved in the nitty-gritty of policy reform advocacy, except for big strategic things where we believe the transparency can be shifted one step further. We do this primarily through research and analysis. Both we publish academically, also in peer-reviewed journals, and also in policy advice. And we advise and consult increasingly with governments, with administrative branches, financial intelligence units, tax administrations, in their audit activity, in the operational activity, but also in shaping their policies. We are networking with a lot of other organizations and universities, and also we incubate other organizations. That's also a specialty of ours. We have supported the ICRIT, the Independent Commission on the Reform of International Corporate Taxation, where Joseph Stiglitz is a part of, for example, and some other organizations too. So let me start the first chapter about the political economy of global taxation, and with a bird's eye view before I zoom in on more policy measures. So as scholars of public finance, of corporate taxation, you might wonder, why should you care? What is the relevance of this political economy question? I think it is basically because, of course, the rules and standards and the data that you're using in your research are not happening in any political vacuum, right? Politics shape what data is available and what data you can use. An example that I very much like giving often is the tax haven blacklisting exercises, right? Often tax haven lists are used as independent variables in quantitative research designs to assess the extent or patterns of tax avoidance, of tax evasion, etc. Yet everybody knows, I suppose, that these lists are highly politicized. They are very arbitrary often, binary in nature always, or with 3 tiers, maybe 4 tiers if maximum. And they expose the research design to the risk of selection bias. There's a number of papers out there where we can raise big question marks about the robustness of the results because of this choice of the tax haven lists involved. And I'm very glad to see that the CDW is here at the forefront as well. I saw papers that used alternative measures to basically check and control for tax haven listing biases. So I hope that this context helps your research to become better still. I know you don't need your research to become better necessarily, but as academics, we strive for perfection. So maybe that is my goal, my modest goal, to explain some of the problems of the existing data, some of the existing standards perhaps, and introduce some alternatives that you might hopefully find relevant for using in your research. So who is setting the international tax rules, first of all, in the interest of whom? So the OECD is at the core of this, and we all know probably this, but it's a little bit of an illustration still that I want to give you here about the extent of this. This is just a chart comparing cross-border economic activity. This is world GDP, just for a comparison purpose, to get an order of the magnitude, an idea about the order of magnitude of these OECD policies. You can see that the OECD model tax convention, for example, governs all the 3 economic channels I have shown here in the 3 three columns here next to world GDP. There's world trade, first of all, there's world FDI, stock, inward stock, and cross-border financial investment, both portfolio and banking assets as of 2010, but the others are 2016. So you can see that all that is black here is covered by OECD policies. The model convention, OECD model tax convention covers all the three areas. Then you see, for example, the transfer pricing guidelines of the OECD covers the intra-group trade, which is an estimated 6 trillion. So this is a significant portion, 28 trillion FDI, 21 trillion portfolio and banking assets, and independent party trade of 14 trillion. These are substantial shares of the global economy that is regulated and subject to OECD rule making and rule setting. And it is a very important organization. And it's also important to bear just in mind how the OECD has grown and taken on this role. It has grown out of a small group of countries, the OE, Organization for European Economic Cooperation, set up in the late 40s to administer the Marshall Plan in Europe for reconstruction of Europe. And it was made up predominantly by the former European colonial powers and the US. So the OECD, or before the OECD even started, the fiscal committee set up by the OEC in 1956 already was beginning to develop the principles of the global tax rules through the Model Tax Convention. So this was during a time when the United Nations was paralyzed because of the Cold War. So let's bear in mind this history that the OECD has grown out of colonial era colonial powers, and at a time when the decolonization wasn't finished yet. So this was an organization dominated by colonial interests. And I argue that a lot of its rules today are shaped by this history. We can observe an interesting fact about the OECD standards. The OECD member states are usually quite good at implementing their own standards. But there are, of course, doubts that these standards are robust enough to counter illicit financial flows, or tax avoidance, or tax evasion, however you want to call these, money laundering included. When we apply more demanding standards, such as from the Financial Secrecy Index or the Corporate Tax Haven Index, both of which we research and publish every 2 years, and I'm showing you more details later on, an interesting observation can be made here. Here is the secrecy score. So this is the intensity, how much the rules of a country, bank secrecy, etc., allow the hiding of finances from foreign authorities or from the public view, wherever that is appropriate. Banking data is not a case for public access, of course. And here is the Haven score, the equivalent measure of aggression in enabling corporate tax avoidance. So if you look at the OECD member states, these are the black dots here. They are concentrated in the bottom left quadrant, or at least left of this line. Almost all of these have below average, these are the medians of both data sets, below median secrecy levels of secrecy. But if you look at the black squares, these are the dependencies of the OECD, like the Cayman Islands, the British Virgin Islands, Aruba, Curacao of Netherlands. These are concentrated at the very top right, and they have far, far higher levels of financial secrecy. So we can posit and conclude from this that there's an outsourcing of the dirty level, higher levels of financial secrecy happening, orchestrated by the OECD member states. We see the OECD countries have on average a secrecy score of 54, and its dependencies, however, of 73, which is far higher, and is above the global average of non-OECD members. Some of the outcomes of the OECD's tax rules and the domination of the international tax rule setting agenda for a few decades is the tremendous growth of FDI that is routed through small island territories or offshore jurisdictions, like you can see here. Like these are the overseas, the OECD's dependencies in these. We see that this is a logarithmic scale, so this underestimates the extent of it. If I hit click, this is like the true unlogarithmic growth of FDI over GDP in the small island OECD dependencies. You see how no other place has experienced any similar comparable growth, extraordinary growth of inward FDI as a share of the GDP than the OECD's dependency territories. These FDI stats are an indication for that this is not greenfield investment, right? There's no factories, there's no laboratories, there's no research happening in Cayman, in the BVI. This is plain profit shifting. This is an indication of debt loading, of intra-group financing activities, at best merger and acquisition, private equity stuff, but not greenfield investment, not the stuff that policymakers usually seek to attract whenever they speak about FDI. This is also interesting that the trend doesn't seem to reverse with the onset of the OECD BEPS initiative that started in 2013 and 2015. The first action plans were enacted. It would be interesting to see how this continues. My strong hypothesis is that you do not see a reversal of this trend that is substantial and lasting. So what are the outcomes of the OECD's tax rules? We see tremendously high global tax revenue losses for most countries. This is from our latest in the future flagship annual report, the State of Tax Justice, where we combine and estimate with the newly available country-by-country reporting data, for example, and with some relying on some methodology from Zuckman, we estimate the offshore tax evasion by high net worth individual cost and the cost of corporate tax abuse, profit shifting, globally speaking. And while these numbers are quite high, what I want to focus on here is the unequal distribution, right? When you look at what countries are losing, how much, in absolute terms, it's the OECD, the higher income countries that lose most. But if you look at the relative losses over tax revenue as a share of tax revenues, you see that the losses are double as high, or in terms of health budgets, for example, 5 times as high in lower income countries than in higher income countries. In addition to suffering these losses, as I indicated before, the methodology here in the, also points to the fact that most of that, the responsibility for most of these losses is borne by OECD member states. If we combine the OECD and its dependencies, we see that 70% of the 427 billion that I just showed you is under the direct political responsibility of the OECD countries. If you just focus on the axis of avoidance, for example, it's a term that is widely in use in the media. It's this is the Netherlands, Luxembourg, Switzerland, and the UK and its dependencies. So 4 OECD countries only are responsible for over 50% of the global tax losses. At the same time, we have to also bear in mind that those who benefit in terms of higher after-tax returns, if there is a benefit, there's reasons to question this, but assuming, you know, who is the actor that benefits from this, it's the banks, it's the multinationals and their shareholders, and the high net worth individuals where they that benefit from these tax losses, or from the higher after-tax returns or from the untaxed revenues, and these are predominantly also located in OECD member states. Now, who is to blame, or what have the countries done about this? Right, this is not necessarily novel. This problem, it has been on the agenda. The harmful tax competition report of the OECD 1998. There have been 2 dominant discourses around, 2 dominant narratives to explain and to engage in this blame game. The first is the corruption narrative, which gained traction in the 90s about, you know, these corrupt countries in the global south, they're responsible for all the losses. They are just not able to handle public finance. They embezzle it, so they are to blame. So here's the World Bank programs and the Corruption Perceptions Index that reinforces this. So this is the one big political narrative and economic also big theme that has driven also a research agenda forward. And the other one is the tax havens scapegoating mechanism, right? You argue that, you know, the tax havens are to blame, and if we had those under control, then the system would change and would suddenly end these kind of abuses. We argue that these 2 narratives are part of the problem because they help easily maintain a status quo. And the problem is always who defines the corrupt and who defines the tax havens. Corruption, who is more corrupt? The one who basically takes a bribe for bringing their kids to a doctor in the duty of a police officer, or the banker in Frankfurt or in Zurich who accepts billions or millions of kickbacks or of handles the money without asking questions when someone asks and deposits this funding. So I think this is the outcome of this debate is the terminology of illicit financial flows. In order to overcome these artificial distinctions in either ors, the IFF's illicit financial flow terminology can encompass all of these, right? Tax abuse, illicit and corruption monies, money laundering. We have a term that brings these two together, and this is also how the United Nations set itself a goal to reduce these illicit financial flows as part of its sustainable development goals. And the common denominator of the IFFs is financial secrecy. And now I'm going to the second chapter, to the final policy and data side of this. Financial secrecy enables illicit financial flows. For these to happen, you need to be able to hide them away. We define them as flows, transfers of money from one country to another that are forbidden by law, rules, or custom. We are deliberately choosing not a definition that is adamant about the illegality of it, because you end up in endless conundrums about if it will stand up at court or not, and you can only know for sure after the fact. There's a lot of gray areas on purpose built into the IFF debate. That's why we choose this definition. And IFFs are hidden by definition. The hypothesis of the IFF tracker that I will show maybe later if we have time is exactly that the likelihood of an illicit component increases in a degree of financial opacity in any given transaction. And I think we have had enough whistleblowers that illustrated and leaks that illustrated the wide range of illicit financial flows involved that flourish under the cloak of financial secrecy. This encompasses both illegal origin capital, like the classic money laundering of drug, money, human trafficking, embezzlement, corruption, but also the legal origin capital, like tax avoidance and evasion. What do we understand by financial secrecy? It's impossible to tell you in one slide. This is just a very simplified schematic thing. Like, assume on this chart, an individual in Germany on the left-hand side owns different kinds of assets in the black boxes that you see here. For example, a house in the same country, or some cash, some gold, art in a bank account, or in a free port somewhere. And if this individual wants now to keep these assets hidden for whatever reason, tax evasion, avoidance, money laundering, corruption, whatever reason, this chart shows you some ways how he would do this. First of all, is not to register, to basically own assets in places where you do not have register owners. For example, owning houses or real estate in countries without a real estate register is already a safe bet. And if there is a real estate register, choose one where there is no ownership recorded. Germany is a good example. You do not have any publicly accessible real estate register. The next type of asset you would use is cash or gold, where no one knows who the owner is, and you can use maybe a free port to hold these in gold bullion, where again nobody records the owner. And but these kind of structures would be difficult and increasingly risky, right? Nowadays, with information exchange, your identity might come up if you have and own these things in your own name. So the next level of sophistication that an individual would use is to just not register these assets under your own name, but through different kind of legal structures and vehicles. These are the yellow boxes that you can see here. You can use a trust, a company, a partnership, a private foundation, bearer shares, nominee shareholders, nominee directors, so that the person would never appear as owning anything in their own name. Of course, the more layers you have, the easier it is then to achieve secrecy, and an authority would need to find out each owner of each layer in order to be able to pierce through and find out who is at the end of the chain. So in the last strategy, to achieve financial secrecy is then involving to spread all of this throughout the world, not only in one jurisdiction, but owning assets not only in different jurisdictions, the assets themselves, like the house here, the bank account there, but also to spread these legal vehicles and structures across different countries. So this is obviously because then anybody who wants to find out, a tax administration, a financial intelligence unit, who might want to find out who this person is or who this asset belongs to, will need to start asking, for example, authorities in Switzerland about, who owns this bank account? What do you know? Can you confirm? And the Swiss will simply say, oh, I only know this is owned by a bank by a company from BVI. And then you will need to go to ask BVI. The BVI in turn will say, oh, I only know this is a trust from Cook Islands, and so forth. And you need to untie each chain, step of the chain. And as soon as there is one country involved that you do not have an information exchange agreement with, or as long as there is no speedy responses, the investigation is stalling and there is no law enforcement. And this is what we hear from many, many law enforcement people, that in fact, whenever there is an offshore structure involved, the chances to actually get to the bottom of this are even today pretty slim indeed. Zooming in a little bit on the data, we measure the level of financial secrecy provided to non-residents in a country's laws and regulations and administrative practices that are documented in 20 indicators that are grouped in 4 categories. So the first category is ownership registration. Here we look at levels of banking secrecy, but we do not only look at, if there is a prison sentence for banking secrecy only, we also look at whether or not there's actually record-keeping obligations for 10 years of the data of accounts that are open. Trust and foundations register. Do private foundations and trusts need to register in a country? This was unthinkable a few years ago, and now it has become policy in the European Union already, and hopefully will make it into the FATF standard next time in 2022. Other wealth ownership. This has data about free ports, luxury free ports. Is there any transparency of other luxury free ports available in a jurisdiction? And then is there any ownership registration? It contains also a component on real estate registries. Is there a central registry for real estate, and are the owners registered, the legal owners and the beneficial owners? In the legal entity transparency category, we have issues such as the country-by-country reporting, public country-by-country reporting, but also we have questions on the local filing under the OECD standard of CBCR, whether there's a robust filing requirement. And there's other issues such as tax rulings, whether tax rulings need to be disclosed, mining and extractives contract publication. The third category concerns integrity of tax and financial regulation. Here we look, for example, also into the issue of golden visas. Are there golden visas available for individuals to basically move and buy residencies, fake residencies elsewhere? We look at issues such as bearer shares. Are these still around? And we check a number of public statistics if a country makes available the most state-of-the-art public statistics, aggregate data for research purposes. And the fourth dimension, finally, is the international standards on cooperation. Here you have a number of things that are basically mirroring what the FATF do. These are the FATF standards of the anti-money laundering group in Paris. This is automatic information exchange. How many information exchange relationships are countries having? And all of this is fully referenced to source. You can check in each of these IDs the page number and the publication where we have found that data, and also in notes explaining each data point, where we need to reason and argue for gap analysis. You will find that publicly available. We have plowed through a lot of laws, and we have a legal team who do this. So I encourage you to check out this database and see if that could be of interest to you. We have in the entire index, it's always the weakest link principle that we apply. For example, when you look at public company accounts, for example, you will see in Germany, there's a no. Germany doesn't get a full public company accounts score for, I think, 2 reasons, but I will focus on one reason. Because there's an exception for the requirement to publish online your financial statements in Germany if your subsidiary in Germany is consolidated with another corporation in the European Union. So that allows you to hide away your finances and what you pay in taxes, what you have in turnover in Germany. IKEA, as far as I know, in 2006-07, there was some reporting about IKEA's tax avoidance in Germany, and as a response to this, they changed the way they file statements, and they made now use of this exception, and no longer can you therefore easily ascertain what tax and what turnover IKEA has in Germany. Then we combine, for arriving at one single index that basically measures the contribution of a country to global financial secrecy, we combine the secrecy score, the intensity, with a measure of extensity. So how much is the country used by non-residents in financial services activity? Here we take a methodology from the IMF, 2007 working paper, to ascertain a country's market share of financial services exports. So I don't need to explain to you probably what that is. If I can happily do so after that, if that's useful. And then we combine the two to basically correct for the misperception of many of the blacklists, because it is not only relevant for the attractiveness of a country to hide money if the secrecy is at the highest and maximum. For example, think of Somalia or a failed state, right? There might be full financial secrecy, there's no disclosure whatsoever. And there were even rogue sort of financial service providers 10 years ago. We found offers in the internet that tried to lure you to invest in Somalia and by lawyers claiming this is like fantastically offshore. But of course, nobody in their right mind would do that, because you might risk never see your money again. So you need legal certainty, and also the bigger the volume of financial center, the harder it is to find illicit financial flow in it. So as with a needle in a haystack, you would be able to hide in a bigger financial center much more easily huge volumes of illicit monies than in a smaller financial center. These are the results of the last 2020 Financial Secrecy Index. Cayman Islands is first, then United States and Switzerland third. There was a big change that the United States overtook Switzerland and is now on the way to become #1, perhaps in 2 years. As you know, the United States is a holdout to the Common Reporting Standard. It does not exchange automatically on a reciprocal basis with any country in the world. It has a huge loophole there and attracts, therefore, dirty, untaxed money from across the globe on an ongoing basis still. And we have a lot of registration problems of Delaware companies. There is no beneficial ownership registration, and even with the new law that was just passed on the Biden administration in January, I think, or February, I don't remember which of the 2 months, and even there's ongoing concerns with big loopholes. Just one last highlight here, the gray countries here are all overseas dependencies of the UK, and therefore if you combine those with the United Kingdom's score, the United Kingdom would rank #1 by far. There's hundreds of anecdotes and academic literature and articles on how blacklists are politicized, how they miss the elephant in the room, and how they are scapegoating small, insignificant, politically not protected areas like Guatemala and Trinidad and Tobago, were the only countries that were judged to have missed the ratings of the Global Forum, whereas the United States, the OECD banned the rules for the United States to not be blacklisted, and the European Union did the same thing. There's blogs, there's also articles around. It happened with every blacklist across the years. It is always a game of removing those that are politically connected at the soonest, and therefore those that remain on it are not the ones who are really a cause of the problem. I think it's fair to observe that Fiji or Trinidad and Tobago are not the big players in corporate tax abuse or in private individuals' tax abuse or in any other dimension of financial abuse. And you can see this illustrated also in this European blacklisting exercise approach. You have various levels, various versions of the blacklist published by the European Union. There was a grey list as well since 2017. And you can see how that grey list initially covered about 40% of the global financial secrecy measured by the Secrecy Index. But this has been reduced to less than 10%. And on the blacklist, there was never more than 10%. And Cayman Islands was removed in the last instance after it was put back on, and after heavy lobbying by the UK to remove it. So we can see how these lists are not objective and don't withstand scrutiny when you start probing them. To sum up, the Financial Secrecy Index is much more than just a ranking. You see, we have detailed research reports, a codebook methodology is available online for download. You have narrative reports that gives you a more journalistic political economy history account of the country, and then the detailed technical database reports with the detailed sources where you can actually read up what a URL, what a publication is that we base our data point on. In the interest of time, I think I will proceed now to the next chapter and not show you there. And just on a final note, financial secrecy is not something that is only pursued by individuals that seek to bend the law or break the law. It's also interesting for and relevant for corporate multinationals, tax avoidance purposes. This is a piece of evidence that was published in the wake of the Paradise Papers concerning Apple, that had asked the firm the data was leaked from, Appleby, to find them a country where they have to reveal lease data in a jurisdiction. So they were shopping for jurisdictions to establish a subsidiary where leased company information was required to make information available publicly for the public to view. On corporate income taxation, the Corporate Tax Haven Index, the first issuance has been published in 2019. It ranks countries by their contribution to global tax avoidance risks. And this complements the Financial Secrecy Index, which has more a focus on the illicit financial flows of individuals and criminal activity. And but the structure of the index is similar. We have two components. One is the Haven scores, and the other one is a scale indication. We assess the aggressiveness of the tax policies that give rise to tax avoidance risks, that engage in tax-based poaching, if you like. And then we have a quantitative component, which is the average of inward and outward FDI of a country derived from the IMF. We have, again, 20 Haven indicators and 5 categories. The first category is the LASI, the lowest available corporate income tax rate in a country. I will say a little bit more in a moment. The second category is the loopholes and gaps. Third is transparency. This is an overlap with the Financial Secrecy Index. Then we have anti-avoidance and double tax treaty aggressiveness. This is a complex econometric model that we have, and there's a paper to be published soon. It's undergoing the final stage of peer review. I can tell more about it. So what makes our corporate tax index, for example, more ambitious than the OECD harmful tax practices is this matter of absolute versus relative concerns, right? The OECD in the harmful tax practices has concluded that for Hong Kong, Seychelles, and Costa Rica, these countries, for example, do not have a patent box, right? And we argue it is a patent box because, in effect, it is the same thing as a patent box in fiscal terms, because Hong Kong, Seychelles, and Costa Rica exempt foreign royalties from their tax base anyway. So you do not need a patent box that specifically exempts any royalties that arise from intellectual property that has been subject or not subject to nexus rules, to OECD constraints or not. It's a plain and outright constraint and exclusion of the tax base that goes beyond and is more aggressive than a patent box. And the OECD concludes in the harmful tax practices, it's all fine. There is no patent box. And we say, no, you're just not looking properly. You have a relative, you're concerned about the ring fencing, about some kind of relative concerning comparing against the overall rest of the tax regime. And we say, it is not enough. In order to assert in loopholes, you need to look at gaps first. And there's a gap if you do not have royalties in your tax base. So we have an absolute standard of assessment here. We look at a country's tax base that should have all of these facets, and then we judge it by that standard. This is the structure presented in a different way than I showed it before. The 20 indicators. Maybe we can discuss more about those. I can say maybe a few more words here. I moved on maybe a bit too fast from the lowest corporate income tax rate. We look at the capital gains for foreign and domestic securities. We look at broad sectoral exemptions, right? Singapore, for example, exempts very broadly a lot of sectors from the taxation. So we take into account whether the full agricultural or petroleum sectors are exempt in a country. The tax rates and economic zones, we compare again these special types of incentive that are very prevalent in African countries or in Latin America. But we also look at patent boxes, and then we have here some whether there's outbound deduction limitations on interest, royalties, and services payments, whether there's withholding taxes on dividends in the domestic rules, and whether there's controlled foreign company rules that are robust. The tax treaty aggressiveness indicator, let me say a few words. It measures a country's overall aggressiveness by looking at the average of partner countries in tax treaties, their average rates in dividends, interest, and royalties, and compares your own country's tax treaty rate with that of the average of the partners' treaty rates. And if your country's rate is lower than the partner's average, then we consider this to be aggressive. And then we sum up everything, and then you arrive at one linear ranking. The results of the CTHI of 2019 are as follows. The BVI, Bermuda, and Cayman lead the ranking. You see the red circle countries are European Union members, and you can see the blue ones that are again dependencies of the United Kingdom. The top 10, they are comprising 40% of today's global cross-border direct investment reported by the IMF. It's $18 trillion in value. And these 10 provide corporate tax rates of 3% or less. And 7 of these countries are OECD dependencies of the top 10 or OECD members. Now, the lowest available corporate income tax rate indicator, it's maybe one of the most interesting ones for your research agenda. Much research about tax avoidance and the race to the bottom rests on the statutory CRT rates. And there are 2 factors in these data sets that distort the findings and the research designs. It's always looking at the highest rate, and it's ignoring the tax base entirely. We have therefore hugely misleading, grossly misleading statutory rates in the OECD, KPMG, GRD data sets that are mostly used by researchers, because multinationals that seek to reduce their tax payments, of course, do not choose the highest rate available, but the lowest available. And they consider how the tax base is calculated. Malta is a striking example. Malta is reported as a 35% CRT statutory rate. And everybody knows, and every advisor advertises this on their website, that Malta operates a so-called imputation system where you get back 6/7 of the tax paid upon distribution. So it is a perfect holding place where your real tax rate is 5%. So what we do, we take the 5% rate at face value or not the 35% to determine the illicit rate. This is a legally derived lowest rate available to multinationals, not an economically derived, and therefore it is also possible to use it as an independent variable in research. Here you can see the deviations from sorry, this is taken from an African focus report. That's why you do not see European Union countries here so much. But I think the salient point I want to make here is this one. The biggest discrepancy between the statutory rates, which are here in gray, and then the illicit rates, which are in color, is found in the European Union. The biggest discrepancy here is the 6%. And here you can see that the race to the bottom is driven by the European Union, not only in terms of the statutory rate, but also, and much more, in terms of the illicit rate, in terms of the rate that is made available through some kinds of playing of base games and other types of tricks. If you can see the different dimensions here, we can compare and find that the European Union and the OECD are leading 3 of the 5 groups. The aggressiveness is highest in Europe and OECD compared to African countries that we had in the sample. To be fair, it's a small sample of African countries. It's only 5 countries in this 2019 index. We have included 5 Latin American countries in this year's index, so we have a little bit more of a robustness in these findings. So this is a really limiting factor of these findings. Europe performs also worse than Africa in that on the 7 loopholes and gaps indicators, except for 2, which is the tax holidays and which is the loss utilization. Here, in these 2, Africa is worse than the European Union and its associations and its dependencies. I will, in the interest of time, I will probably now just wrap up. So there's a few challenging hypotheses that I want to throw at you at least. First of all, can we really say that tax avoidance is legal? I think we cannot. And the reason is that the large overwhelming majority of audits that are carried out result in a tax adjustment. And this ratio usually increases when you look at transfer pricing or cross-border comprehensive audits to 70%. The OECD has discontinued the detailed statistics on transfer pricing audits, which would have been interesting to have for the same year as this one. I think it would have been higher than 58%, but that's my guess. So you can see that the illegality in a tax audit is the rule and not the exception. The corporate tax avoidance happens, this is empirically proven, happens in a legal gray area, which is more often than not found out to be illegal in the outcome. We need to then look at the court outcomes, but for the tax administration practice, the tax notice that the administration gives a company, it's more routine that it's illegal than legal. It's not criminal, that's a different thing, right? But it's illegal. I will also not now show you the illicit financial flows tracker. You can play with this at your leisure at a later stage. And I would encourage to consider at least at the very least as a cross-check of any research designs that have as an independent variables lists of tax havens, to consider the haven scores and secrecy scores as a robustness check, and to consider also the use of illicit rates instead of top tax rates for research designs. And I think this is a final note. There's a recent publication on how a minimum effective corporate tax rate can be designed at the OECD. This is not directly in my remit, but colleagues of mine are working on this, and maybe this is also interesting for you to take a look at. I understand this probably is also a research agenda that at ZTW is very at the forefront of developing further. And if you want to listen to any of the podcasts, there's 5 languages available, and I will wrap up here. Thank you so much.